Today, what's better, dividends or growth stocks, and how do we find a balance?
Drop it.
Welcome back, my passive income investors alike, to an extremely tricky question. It comes with a lot of variables and is situated around your specific circumstances. I'm going to give you some lessons from my own six-figure stock portfolio. Hopefully this is going to help you outperform the market, and if you sit to the end of this video, I'm going to give you some golden nuggets of information that might really help you out that took me years to learn. But first of all, what is a dividend stock? Because many of us here are dividend investors, and we know dividends usually don't come with the highest growth rate. Dividend companies are spread out against many sectors, but a lot of us know them as our REITs, our bank stocks, and our utilities. And these stocks usually don't come with as much risk, and they're usually paying somewhere between a 3 to a 6, sometimes even a 7% dividend yield. Now, dividend stocks can be risky. If you play within a realm of understanding, they're usually much safer companies, but they're not going to grow your portfolio at a fast rate. But at the end of the day, these are the companies we usually want to end up owning as dividend investors because they're going to help us retire one day. Now, the thing that we overlook is these growth stocks. Now, the problem with growth stocks is they have more risk, and risk is associated to volatility, but these are companies like our Amazons, our Teslas of the world, and our Shopifys. Some investors are 100% dividend investors, other investors are 100% growth investors, and I'm going to tell you how you find a balance, because you shouldn't be just one or the other. And like a lot of the times, guys, you can buy companies like Apple that do pay dividends and have a higher growth rate, but you're not really going to be living off those dividends for a while. So I want to share with you how I balance my portfolio and how I've decided to balance it based off my age and my current amount of asset value. So I want to go over the variables on my own set of personal circumstances in a way that I think might help you better understand how to, gauge out your portfolio as you move on to a later age. And this will help too if you're already in a later age in life, if you're 40 plus, or if you're in your early 20s. So the way I started investing and leveraging my risk was when I was in my early 20s, I started investing in the stock market around 23 years old. I did not have a lot of money, and I knew when I got into the markets that it was the best time to take on the most risk, because for me to lose the money wouldn't be a lot, and I was so young, I had a lot of time to recover. So the first two companies I ever bought were Canopy Growth Corp, which we know is one of the largest MJ stocks, and then I was also buying a company called Northland Power, which is a utility that pays out a 5% dividend yield, and I felt this was a very appropriate 50-50 split in the early days. So I was getting some dividends along with a lot of capital growth. Now, as the years have gone by, Canopy Growth Corp exploded and did very well for my portfolio, and as my portfolio grew up into the six figures, I decided that I don't want to take on nearly as much risk. So I'd rather cut the risk down, and so one day, even if it's in the near term future, I can tap into those dividends when I need them. But trying to find the balance of not giving up on those growth stocks that could give us a 15 to 20% rate of return, you got to kind of find this risk associated with the balance. So what I'm doing right now, I'm 27 years old, and the way I have my current portfolio leverage is I'm about 30 to 40% high risk and about another 60% to 70% very low risk that pay very good dividend yields. And I really think this is appropriate, as my stock market's giving me an average rate of return but is between 15 and 20%, including the dividends, and I'm able to collect about $450 a month, or about a 4.5% yield off the $130,000 that I currently have invested. So if my higher risk stocks were to take a bit of a dip, yeah, I could see a severe reflection in my overall value of my portfolio, but at the same time, I'm still so young that the growth that I could experience could be so exponential by the time I hit my 30s and 30s going into my 40s. But as you head into your 40s, you do not want to take on nearly as much risk, because you're going to be looking to utilize the dividends and your portfolio much sooner than I might be. So what you're going to need to do is lower your risk, because you couldn't afford a company like Canopy Growth Corp dropping by 50 or 100%. That could really detriment your income. And this is purely based around how much money you have today. If you're in your 20s and say you inherited a bunch of money, say you're sitting on a couple $100,000, or maybe even $1 million plus, you do not want to be taking on that high of risk. Honestly, if you have anything getting up to $500,000, $1 million bucks, you're going to be more focused on ETFs at that point, because you're going to want the lowest risk to guarantee that income, because at that point, if you could just make 5% on $1 million, you're bringing in $50,000 a year. And I would rather have that much more secured than having it in a risky company that could drop the portfolio by 20 or 30%. So there's a lot of variables we can see that come into play. It's very risk based on how much money you already have and how much you want your portfolio to grow. You can't get greedy when you start getting a lot of money. But in the early days, if you only have 100,000 or a couple 100,000 you've been building up, I think it's very appropriate for you to be taking on about 30 to even maybe 50% risk if you are in your early 30s or your mid 20s. I think it would be the most appropriate way to adjust your portfolio. And guys, once you get into those 40s plus, you don't want the risk. Now, if you're trying to find growth because you don't have that much capital, the way to gauge it into your later 40s or 50s or 60s is you still might need growth if you don't have enough capital. So if you don't have enough capital and you're in your 40s already, you're going to want to take on higher growth. So how do we do that without taking on as much risk and still collecting a dividend income? Well, these are where you're going to look for these golden nugget companies. These are your companies like your Apples and your Microsofts of the world, and you're going to want to make them a larger part of your portfolio. Apple, Microsoft, and Tesla right now make up 30% of my portfolio, and Tesla is the only one that doesn't pay a dividend. So I am seeing extreme growth between those three companies while I'm still collecting a little bit of a paycheck. And then the rest of these companies that I own, like my banks, my utilities, my REITs, they're paying me a much higher yield, but they're not giving me the rate of return that I like seeing that I'm getting from, say, my Apples and my Microsofts of the world. So trying to find this balance can be extremely tricky based on your investment philosophies and strategies, but I don't want you to be a 100% dividend investor, and I don't want you to be a 100% growth investor. You need to try and find a balance. Now, where I think you get really rich, because if you think Apple and Microsoft are golden nuggets, imagine buying a dividend stock that's paying a 5 to 10% yield, and then the equity or the stock value goes up by 10 to 20% a year. How do you find those kind of companies? Well, I'm going to give you an example of a company, two companies that I bought last year that exactly resemble what these value stocks are. And these are where you're going to get really, really wealthy on the dividend and the growth aspect. But it's going to take a lot more homework, and it's going to take a lot more patience to find these companies. And we're talking about my two companies that I recently purchased last year are companies like MO and BTI. These are sin stocks. They are unfavorable, but I think they sit in a fair valuation. And I was picking these stocks up for like basement bottom prices. And now what I've seen is I'm getting about a 7% yield off these companies, and the stocks are also going up by 10 to 20% a year because I felt like they were severely undervalued against the basic market. And now what we're seeing is I'm getting a 17 to 20% return with the dividends, and these are really great companies that I could hold for the rest of my life. Now, these companies are hard to find, and they do come up, so you have to pay attention throughout the year. Companies like Chipotle went through this, Apple went through this, and it's kind of taking the recognition of realizing that yes, you're going to have to go against what people are saying, and it's going to be very hard to stomach, which makes it hard for investors to do. But if you can pull this off successfully, you will be like a Warren Buffett investor making incredible rates of return. And if I can leave you with one more nugget of truth, stick to the S&P 500 stocks. A lot of us can be super attracted to small cap companies that might only be worth a couple $100 million that pay higher dividend yields, but these companies usually do not have a track record, and you have to be very careful because there are something called dividend yield traps where we get kind of attracted to these higher yields and we think we're finding a value stock, but this is why you're going to have to deep dive into this, guys, because if you don't and you end up getting what they call value traps, where it looks like this stock is paying a high dividend yield, it's on a discount, but for some reason the stock's losing capital and the balance sheet is going down on revenues, you're going to find yourself in a poor situation. And I have done this myself. I am a victim to this 100% with a company called BRE, Brookfield Real Estate Services. This company got bought out, but I was holding this company based on the dividend yield, and I kind of like the fundamentals of it because it was based off realtors paying royalties to work for companies to sell real estate. But when you looked at the company's balance sheet, they weren't making capital, and the fact that their dividend was as high as it was probably not appropriate versus the revenues. And I saw a decline in the stock, and then after further doing my homework, I realized realized I was in a value trap stock. Sure, you're getting a high yield, but that high yield is barely covering the stock price as it drops. Now, like I said, this is an extremely complicated topic. It sounds very simple, and you guys just want to avoid those low cap, risky companies. Honestly, if you want a very successful portfolio, look for companies in the S&P 500. Those top 500 companies have a very wide range of dividends and growth stocks, and you can kind of start picking a basket of a few, knowing that you're taking on companies that have a decent track record, and you want to find the ones that have been around for a while. I'm going to leave it there. If you guys have further questions, let me know in the comment section below. I would love to hear what you guys have to answer. Usually within the first few hours, I answer a lot of the comments. I'm going to try and do better at this because I've been so busy, but I love engaging with you guys. So stay cool, stay awesome. I look forward to chatting to you real soon.